This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Why do we fear things that happen on a normal basis? That was the question that we posed this past week on Facebook, and we're posing it again this morning here on Sunday morning. Good morning, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and you're listening to News Radio 93.1 WFLA. If you're watching us during the course of the coming week, then you're probably listening to us on any one of our podcast channels, from Facebook to Twitter to Google to iTunes, whatever the case may be. We've got a channel for you. And then also on YouTube on a video format as well. We've got the camera set up. Nowadays, in order to get the camera set up, it means I have to get here a little bit earlier, dress a little bit nicer, and hide my face behind the mic a little bit, seeing how it's really more of a face for radio all these years. But now we've got something on video. Uploading this one and last week's program this coming week. Still learning the process of how to do all of that. So be patient with us, but you'll eventually see the insides of the iHeartRadio studios, and I can tell you they're just absolutely fantastic. We had a lot of conversations this past week. Interviewed on Michael Yaffe's evening drive time show, and then an early morning conversation on Bud Hettinger's Good Morning Orlando on Thursday. In case you missed it, there was something called an inverted yield curve. So obviously we'll be talking about that on the program today. Probably talk a little bit about trade, and in particular the headlines from Hong Kong. There's some interesting implications there that we'll be talking about on the program. Also, we will continue the conversation we started last week but ran out of time. As is the case on radio, you're restricted to, hey, you got to be out by 10 o'clock. We ran out of time on the conversation of reasons why you may want to convert a Roth to a traditional IRA. You don't often hear about that. Usually it's the other way around, but we wanted to talk to you about the option to go the other way. So we'll cover all of that on the program, and then, of course, we do have open lines here in the studio, 407-916-5400, toll-free 1-866-916-5400. And then, of course, if you'd like to hit us up on the email is my first name, Joel, Joel, at NelsonFinancialPlanning.com. So that's how you can get in touch with us and add your topic to the conversation. Maybe you've got a question on this silly inverted yield curve stuff, but hopefully we will certainly get into the details on all of it. So let's start with that conversation about an inverted yield curve. And first of all, what in the heck is it actually? Well, I think the simplest way to think of it is we often talk about emotions getting involved in the performance of the stock market on a daily, weekly, and sometimes monthly or longer basis. We don't often hear about investor emotions affecting the bond market, but when we talk about an inverted yield curve, that is in essence what we're talking about. because an inverted yield curve basically means that people are more fearful of the near term than they are of the longer term. Because what happens in an inverted yield curve is that if you think of it as borrowing money, because that's in essence what a bond is. A bond is a debt instrument. So once you kind of start to think of it this way, think of it if your buddy came to you and said, hey, I want to borrow money and repay you over the course of a 10-year period of time, versus another buddy came to you and said, hey, I want to borrow the same amount of money, but I'm going to repay you over a 2-year period of time. Where would you typically have the bigger risk? Well, you would typically have the bigger risk on your buddy that you're going to be getting payments back from over a 10-year period of time. Longer period of time in terms of the payback, then a higher risk associated with that. What happens when you take on higher risk? Well, you charge more money. So typically the interest rate on a 10-year loan is going to be higher than it is on a 2-year loan. What happens when the yield curve inverts is that when we look at U.S. government debt, U.S. government treasuries, and we compare the yield on the 10-year note, meaning the 10-year repay, versus the 2-year note, 2-year repay, we find that for a period of time this past week, the interest rate, in fact, on being able to have a repayment within a 2-year period of time actually moves slightly above where the yield was on the 10-year. So if you think of it in terms of kind of how that chart sort of generally looks like, it looks like kind of a gradual, increase up a mountain. But meanwhile, when the yield curve inverts, then you wind up having a little bit of a bump up initially, so it doesn't look like a mountain. It almost looks like sort of the backside of a mountain, and so consequently, that's what's known as a yield curve inversion. It sort of flips, if you will, rather than kind of think of it as generally climbing up the hill. It looks like sort of the backside of a hill. So what's interesting about all of this conversation that we heard this past week about inverted yield curves is that they don't cause a recession. Let's get that out of the way right out of the gate. Inverted yield curves do not cause a recession. They are a part of the economic cycle that we all know goes through periods of expansion and periods of contraction. The good news is when you think of it from an economic point of view, those periods of expansion are much longer and much stronger than those periods of contraction. If you look at the history of the markets over the course of the past 100 years or so, you'll certainly easily be able to draw that conclusion. So when we think of the economic cycle, at some point, when we get towards the end of the expansion part of that cycle, folks start to get nervous about the end of it. And so consequently, that's where the emotions come into play when we're talking about the bond market. And then that causes that push up of interest rates on a shorter term basis relative to the interest rates on a 10-year basis. So that's what the concept is all about. Inverted yield curves don't cause a recession, but they are a part of every economic cycle where at some point you will get emotions feeling like the nearer term is going to be tougher than the longer term. Where do those inverted yield curves typically occur? Well, they typically occur towards the end of an economic expansion. I would submit that we're certainly closer to the end of the current economic expansion than we are to the beginning, because the beginning started back in 2009, 10 years ago. We're probably closer to the end than the beginning, that's for sure. So typically, an inverted yield curve would be something that you would expect to find. Now, here's the interesting statistics and numbers that we shared with Michael Yaffe's program this past week and Bud Hedinger's program this past week. There's a period of time that still exists between where you would see the yield curve invert and when you would actually see the start of a recession. And it's a chart that we actually posted up on Facebook, and we'll hold it up for, it's this chart right here. We'll hold it up for our folks that are watching us on video. It's, like we said, it's also posted on Facebook as well. And what it actually shows is, looking back over the course of the past 30-odd years, what you'll find is that their average length of time from the period of inversion to the period of the start of a recession is, in fact, on average, about 16 months. So there's still a long time before you would say, oh, our economy is in a recession. What's far more interesting about what happens from the point of inversion to the point of the ultimate start of a recession is, in fact, the market actually does pretty decently. If you look at kind of the chart again that we've put up on Facebook, the reality is that the market continues to move upward between that period of the point of inversion and the actual start of a recession. What's even more interesting is how strong that number is. We'll take a break. When we get back from the break, we're going to share with you what that number is. And that's going to be kind of surprising, just how much the market still performs, even though we've hit this mythical point of inversion in terms of the yield curve. We'll talk about that when we return here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning, and you're listening to Dollars and Cents here on News Radio 93.1 WFLA. Simulcasting over there on the AM 540 dial as well. And, of course, uploading to video. You will see that this coming week. We've got a camera set up. And the cool thing about it is that when I actually hold up see the chart thing, now people can actually, kind of see the chart. You may have to, dial, kind of expand in pretty good. But what we'll certainly do is anytime we talk about something on the radio program that has a chart or something like that, we'll certainly endeavor to put it up on Facebook as well. So before the break, we were talking a lot about the inverted yield curve, trying to get an explanation on the table of exactly what it all means. In simplest terms, it basically means that fear or emotion found its way into the bond market this past week. And so what that means is then that you've got interest rates on shorter-term loans or shorter-term debt that is, in fact, at a slightly higher rate than longer-term debt. What's fascinating about this point of this yield curve inversion is that there's still a long time before the point of inversion and the ultimate start of a recession. I think many in the media were pushing this idea of, the recession is going to start over the weekend. And that's certainly not the case when you look at particularly things like retail sales and low employment numbers that would suggest something very different. Well, that would actually go hand in hand with the data that we see in terms of how long the period of time is between an inverted yield curve and the actual start of a recession. If you look back over the course of the past 30 years, you'll find that it's about 16 months. So that's still a long time. What's even more interesting is the number that we were going to get to, and then we took a break. But here it is in this segment. the performance of the market. The performance of the market during that period of time, on average, is up another 37%. I'll say that again, up another 37%. That's a pretty good return that I don't think you really want to miss out on from an investment perspective. Despite that, of course, this past week, there was a record $16 billion pulled out of equity or stock mutual funds. So everybody always kind of misses what actually happens, particularly when the media really does drive the overall commentary on this inverted yield curve. They always look for something that is going to be highlighting to get people's attention. Speaking of people's attention, we've got Owen on the line from Palm Bay. Hey, Owen, good morning. How are you?
Hey, good morning to you, Joe. I'm fine, thank you. I hope you are.
I am well as well. It was an emotional week in my household, and not because of the inverted yield curve. It's because I dropped my oldest son off at college for the first time. That was an experience.
Oh boy, I'm just turning the page, I guess, huh, Joel?
The next chapter. I'd like to think that I'm getting younger, but the reality is that the experiences that I'm having proved otherwise.
I know you're proud too. I know you're very proud, as you should be.
Well, he's gonna have a good time up at Auburn, and hopefully he'll get some studies in as well.
He's going to Auburn?
Yes.
Well, maybe we'll see him on the. They're crazy for football up there.
Yes, they are. That's
Alabama.
Right. That's a big stadium they got on campus. That's for sure.
Right, Joel. The question I had is
sure.
The inverted yield curve and everything. It kind of gets me. I don't understand everything, but I've been reading financial stories, and I wanted to ask your opinion. A lot of financial people think a recession is the start of a recession is 2 consecutive quarters of lowered industrial trade output, and I just wonder, that's something that comes out every 3 months, every quarter. That's
correct.
I could look at and see. I just want to know what your opinion on that
well,
is.
that is the sort of the technical definition of what a recession is. So the technical definition of a recession is you get 2 consecutive quarters of negative GDP growth. Okay?
Yes.
So right now, the latest GDP numbers typically over the past many quarters sort of in a range of 2 to 3%. I think last year we were getting a little bit closer to the 3 as a result of the tax cuts, but that is the technical definition. Definition of a recession is you get 2 consecutive quarters that are negative in terms of GDP. So again, that's why these folks in the mainstream media that are suggesting that now that you've hit the inverted yield curve, the recession is going to start tomorrow. There's usually an extended period of time, almost a year and a half on average, before you will see that recession start. You actually need some of the real economic data to start to shift. And when you look at some of the current economic data out there, particularly involving retail sales numbers that came out this past week were pretty strong. And so consequently, that makes it a little bit harder to really come to this conclusion that everybody is kind of jumping to that, the recession starts tomorrow if you have an inverted yield curve last week. And that's certainly not what history tells us, is that there's a space and time there between inverted yield curve versus the start of a recession. Inverted yield curves don't cause recessions. Recessions are caused by economic data. An inverted yield curve is something that you typically see later on in an economic cycle, but they do not, in fact, create a recession. Things like people not spending, businesses not hiring, businesses laying off, those are the traditional indicators of a recessionary period of time.
That you're going into a recessionary thing. That's
Right.
something myself, I guess anybody can understand. There's just a slowing down for whatever reason. It could be geopolitical, all around the world where countries are kind of falling. But that's something that I will look at. And the people, like on CNBC, a lot of them this past week, they had us in the recession. We're going for it, and they're totally wrong so far.
Well, I think again, it's bad news always attracts people's attention much more than good, and I think there's a tendency of the mainstream media to really kind of try and jump on that and fixate on that because it is negative news. And as we were talking about on the program last week, negative emotion or pain of a loss has a 3 times an emotional impact on us versus a positive event. And the media know that, and so certainly they focus on that. But thank you very much for that call, Olin. We certainly appreciate it, and fair commentary on this conversation about a recession and the timing. And the reality is, as we posed the question at the beginning of the program, recessions are, in fact, a normal part of the economic cycle. It always amazes me how much humans fear things that happen normally. There is an economic cycle that has existed in this country for a couple hundred years. Periods of time where things are better and periods of time where things aren't as good. And it's important to know that those cycles are a normal part of the overall economy. I think far too often folks are led to sort of forget that. Our job here on the program is to help provide perspective, which hopefully we're able to do, particularly after a week like we had. When we get back, we're going to summarize kind of it all up. We've got a couple of other topics to touch upon in terms of kind of the week that was, specifically Hong Kong. Got to talk about this Greenland deal too, right? I mean, we got to talk about that as well. Fascinating conversation coming up with this Greenland conversation. So stay with us through the break here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents here on News Radio 93.1 WFLA. My goodness, a lot of conversation about the inverted yield curve. Spent a lot of time in the first part of the program sort of going through that and getting into, hopefully, what you found was a detailed yet understandable explanation of exactly what that was. You can listen back on that during the course of the week on any of our YouTube and social media channels as we post not only the audio but also the video. We'll be dropping video of last week's program as well this coming week, so that there'll be a couple of episodes up in the week ahead. But what's interesting about that conversation on the inverted yield curve and the emotions that took hold of the bond market this past week is, of course, you need to go back to, okay, well, what stoked those emotions? And certainly the conversation about trade really did sort of start the conversation or the concern over what was going to happen in the near term that caused the yield curve to invert. And so consequently, when you think of it from a headline conversation perspective, certainly the emotions that were out there were largely driven as a result of the back and forth between trade. I think what really is fascinating in terms of the trade conversation is what's also happening in Hong Kong right now. Tremendous amount of protests, tremendous amount of reaction in Hong Kong that has to do with democracy, that has to do with independence. And the timing of when that is playing out, I think when we look back on this from a history perspective, it is really kind of fascinating because China finds itself in a very tricky and very difficult position. They're having to deal with this trade conversation and these tariffs and all that, while at the same time, they want to be perceived as a good place to do business, as a reliable place to do business. And one of the concerns in China is that with a communist government, you don't really have the same kind of rules of law that you have here in the United States. And so the situation in Hong Kong is absolutely being looked at around the world as an indication of just where the Chinese are in terms of their ability to let people have the right to protest and the right to be independent. And stay tuned on that. That's going to be a pretty powerful turn of events over the course of the next few weeks. If they respond too strongly, it's going to fundamentally alter the trajectory of their economy. So they're in a tough spot, and then they've also got this tariff and trade war thing happening as well. So a lot going on over there. It's clearly one of the big factors that's affecting the dynamics of the stock market and the bond market as well. But stay tuned on what their response is going to be. They've got to be very balanced and very conservative in their response, because if they go too far, it's going to fundamentally alter their economy, because businesses aren't going to want to do business in a country where the rules shift depending upon what's happening, which could have a major impact for China. We'll slide back to the phones. We've got Kelly in Leesburg. Hey, Kelly, good morning. How are you?
Good morning, Joel. I am great. And congratulations on your son going off to college.
Well, there we go. We still got two at the house, but yeah, it's a little bit of a different dynamic. I found the days leading up to it to be more emotional than the actual drop-off.
Right. Oh, well, I'm so glad you were able to send him to a good school.
Indeed. Yes.
I'm one of your clients, and I'm in the FRS investment plan.
Okay, very good.
Are you going to revise your recommendation for those of us who are your clients in the FRS, or are you sticking with what you already have us in?
Yeah, I mean, most likely sticking with. We're actually going to be generating out kind of a letter that we typically do a couple of times during the year, and so we've got one sort of teed up to go out in the next couple of weeks. But Kelly, refresh my memory, how far are you from kind of hitting retirement out of the FRS system?
About 12 to 13 years.
Okay, then the answer, if you're 12 or 13 years away, is there would be no change in terms of the investment allocation, despite the fact that certainly you've seen that balance shift quite a bit over the course of the past 2 or 3 weeks. I don't know how carefully you or how closely you monitor it on a daily basis, but obviously the balance has shifted from a great start to the year. The reality is that if you're 12 or 13 years away, then there's going to be a couple of more recessions before you retire, because recessions happen every 6 or 7 years. So the normal trajectory of the economy is still going to be the trajectory of the economy. You've got plenty of time in front of you to be able to kind of weather that, and ultimately the allocation that you've got, which would be a portion in large companies, a portion in international, a portion in small or mid-sized companies. That type of mix, Kelly, would certainly be the one that would be the way to get the best possible investment return over time. And you've still got you've still got some time, depending upon how the day goes at work. You may wish the time was shorter, but you've still got 12 or 13 more years. So that's long enough to continue to be consistent with more of that growth approach that we typically use with folks in the investment plan.
Great. I really appreciate your advice on that. Thank you so much.
Our pleasure. And the other comment I would make is if I don't know that we've seen you in the office of late, so we always encourage people to visit with us face-to-face to get more caught up.
Absolutely. Thank you so much.
All right. Sounds great. Thanks for checking in. And so great question from Kelly on the FRS investment plan. For those of you who are unfamiliar with the Florida retirement system, they have an option of staying on a traditional pension or switching over to an investment plan, which is sort of a 401k type of plan. So some great options on that. One of the things that we did at the end of last year was we wrote a booklet about the Florida retirement system and really sort of outlined all of the many details on the Florida retirement system, because there's been a lot of changes, particularly after 2008. So if folks are interested in learning more about the Florida retirement system, we actually have that booklet available to download on our website at nelsonfinancialplanning.com. That booklet is available for a download. So super easy to grab that and learn a little bit more about the Florida retirement system if you're involved in it, or perhaps you know somebody who is. A good resource that talks about Florida retirement system, the health insurance subsidy drop, all of the different options that you have within the Florida retirement system. So that's a good resource of material. The other headline that was getting a lot of talk this past week was the potential purchase of Greenland, right? I mean, who knew that we were in the market for real estate? It's always interesting when a real estate investor becomes president. I guess that is right along with his background. What's fascinating about it is obviously it's not going to happen. It's pretty clear. Danes have come out and said, hey, we're not really interested and it's not for sale. But what you have to understand is that the third largest bank in Denmark, which is known as the JYSKE Bank, I'm not even going to attempt my Danish on that, is offering mortgages with negative interest rates. It's part of this massive amount of debt out there that's sitting at negative interest rates. So what a negative interest rate means is that you are paid to borrow money. So that would be really cool to buy like the equivalent of a continent and be paid to do it. So and then borrow money from the country that is selling it to you. So you could literally today borrow money from a Danish bank, have a negative interest rate on that loan, and basically be paid to buy the country of Greenland or the territory of Greenland. Interesting. Just some thoughts on that. We're going to slide to the break. Dave, hold on. We're going to hop to your call right after the break. And so if you'll kindly hold on through the break, then we will chat about that. Your topic, which looks like it's also a Florida retirement system question as well. So stay tuned for that here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on a beautiful Sunday morning in Central Florida. My name is Joel Garris of Nelson Financial Planning. And we're talking about inverted yield curves. Obviously, that's been a big topic on the show today, but also fielding some questions on Florida retirement system. So we'll go back to the phones, and we've got Dave in Orlando. Hey, good morning, Dave. How are you?
Good, Joel. Good morning. How are you?
I'm doing fantastic.
Great. Yeah. So my wife's a teacher. She's got about 5 more years left till 30 years, and I can't find an answer to. We've considered taking the lump sum, but she may go past 30 years, and I don't know. Do you know if at 30 years they have to make a choice, either drop or lump sum, or they can go like 35 years and then the lump sum will be larger?
So
like that's the case.
Sure, and that is true. So if you're in the Florida Retirement System investment plan, you kind of control when you leave. It's really then based more upon the balance that's in the plan rather than your particular years. Now, obviously, you want to have the 30 years in for things like the health insurance subsidy and some of those other benefits. But if you're in the investment plan, it's not like with drop, where once you go into drop, once those 5 years are up, then you're done no matter what. The investment plan does give you a little bit more flexibility. What we also see, Dave, is that, and I don't know how much you're online and kind of really playing around with the numbers, but the state has a website. It's myfrs.com, and that website allows you to sort of go through this process of trying to project what the numbers will be at certain periods of time. What we often see is that lump sum amount that you would have available in the investment plan really starts to go up in the last few years of when you're approaching your traditional retirement age. So I would encourage you, Dave, to kind of look at what those numbers are, because they do kind of rise up in those last few years prior to 30. And I don't know whether you've been on their system or not to kind of see that. I think you might have made that suggestion, but have you done that?
Yeah, we have. We've looked at it. See, she started teaching really young. She's going to have 30 years. She'll be 52. So We figure she probably needs to work past that, because that's kind of a young age to be retiring or maybe moving into something else. So, but we have looked, and we've called them and got information from them, but we never were able to find out yes or no on that 30 years. It just seemed like we couldn't find an answer. But it sounds like we can go past the 30 years.
Oh, absolutely. If she's in the investment plan, she has 100% flexibility of how long she stays there.
Well, she's not necessarily in the. I know they have the investment plan, which a lot of the younger teachers are taking.
Right.
But this would be. I think you have a choice to take the lump sum or See, that's where I get confused, because I know there's an investment plan and then there's a traditional pension with the option of the lump sum.
Correct. So there's really 3 different options, Dave. First is the traditional pension, so you stay on that for the entire period of time. And the reality is, if she's on the traditional pension, there's nobody that says, hey, you got to get out at a certain date. So she can stay on that and add to the years for that formula, okay? That's option 1 that she has. Option 2 that she has is sort of a hybrid of the pension that comes with a lump sum equal to up to 5 years of what that pension payout would be. That's the drop option, okay? So the drop option is sort of a combination of the pension, but then because, see, when you go on drop, Dave, you actually officially retire, but they don't allow you to collect your retirement check because you're still working for them. So basically, they hold your retirement check in drop, and so all that the drop is just that accumulation of what you would have gotten had you actually collected your retirement, but they don't allow you to do that because you're still working for them. And then the third option is the investment plan, which represents a lump sum of dollars of all of those years that she's worked for the Florida retirement system. So it really is sort of 3 options, and Dave, you're right. That's where the confusion kind of comes into play. Drop is a lump sum, yes, but it's a different kind of lump sum than what the investment plan is. And with the investment plan, then that's 100% on the investment side of things. So then it becomes your responsibility to deal with making sure that the money is doing what it needs to do in order to generate out a monthly income in retirement. So there's really sort of three different options available to you, Dave.
Okay, great. I appreciate it. Thanks for your time.
Dave, I would encourage you to hop over to our website when you get the chance, nelsonfinancialplanning.com. We've got a booklet on all of this that kind of explains all of these different options. And feel free to kind of read that. And if you got more questions, you can always give us a holler at the office.
Sounds great. We'll do.
All right. Thanks for that call. Fascinating conversation as well, because what we often see is a lack of full information, particularly, Dave, among teachers, because we've had folks that have literally had their retirement exit interview with the county and at the end of the day, not really even know about the investment plan as a viable option. That has happened on more than one occasion. And I think it's so important to understand what all of your options are before you make such a big decision like retirement. And that's why we sat down and wrote that booklet 3 or 4 years ago now. We've updated it now. Actually, this is the third version of it. And it's got some good information. It's intended to really describe each one of those options that are available out to you, because there's been a lot of changes on that post-2008, 2009. There was a lot of legislation out of Tallahassee that sort of fundamentally altered what the options were and what the benefits were in terms of the numbers. So certainly worth checking a look at. And we certainly appreciate the opportunity to talk a little bit about the Florida retirement system on the program, because it's a program that has really had an awful lot of changes over the course of the past few years. Speaking of changes, if you wanted to change from a conversion to a Roth, the reality is that that ability to do that has been eliminated, but but you may want to really be thinking about some other things in terms of an IRA instead of a Roth, particularly if you are in a lower tax bracket, or if you do a Roth and you wind up being in a higher tax bracket than what you imagine. One of the things that you could do is you could recharacterize that Roth contribution as an IRA contribution. So you don't often hear about folks going the other way, Roth to IRA, but it can be done, and there are specific circumstances where that may make sense. Let's say that you made a Roth contribution and then all of a sudden realize, well, wait a minute, my income jumped up, so I'm now no longer eligible to even have made that Roth contribution. You could recharacterize that Roth over to be a IRA contribution, and an IRA contribution you can have no matter your income. It just means that you may not be able to deduct that. And if that's the case, then you could do a conversion through the back door after you make a contribution to an IRA. Same thing is true if all of a sudden you're doing your taxes and you realize, oh my goodness, I need a little bit of tax savings on that. And so consequently, the contribution to that Roth could be recharacterized over to an IRA, so that way you could actually save some money on your taxes. So it's not as lockstep as many people think. The reality is that you've got to ultimately run the numbers and look at whether it makes sense to do that Roth or that IRA. We keep running out of time here on the program on that topic. I keep trying to get it in. We'll keep at it and flesh that out a little bit more fully. The music means, though, we got to get out of here. So we will wrap it up, and I certainly appreciate the callers today. Always good to engage in conversation here on a Sunday morning. You've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning here on News Radio 93.1 WFLA. How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.